$200 billion every single year. That's how much money illegally flows out of Africa through tax avoidance schemes, transfer pricing, manipulation, and outright corporate fraud. Not over centuries, not as a one-time historical event, every year. To put that in perspective, Africa receives about $50 billion annually in foreign aid and development assistance. That means 4 times as much money is being stolen from Africa as is being given to help it. The narrative you've been sold is that Africa is poor and needs aid from wealthy nations. The reality is that Africa is being actively drained of wealth by the same corporations and countries that position themselves as saviors. This isn't ancient history. This is the largest ongoing theft in the world today, enabled by a global financial system designed to let multinational corporations and wealthy elites hide their money while developing countries starve. And it's all perfectly legal, or rather, it's being made legal by those who profit from it. This is how tax havens work. This is who benefits. This is who pays the price. And this is why the system was built this way. Let's start with a simple question. How do you steal $200 billion every year without anyone noticing? The answer: you don't call it stealing. You call it tax optimization. You call it corporate restructuring. You call it competitive business strategy. You build a global financial architecture that makes theft look like accounting. Here's how it works. Imagine you're a mining company extracting gold from Ghana. You pull billions of dollars worth of gold from Ghanaian soil using Ghanaian labor on land that belongs to Ghana. Logically, you should pay taxes to Ghana on the profits you make from that gold. But you don't want to pay those taxes. So, here's what you do. First, you don't set up your mining operation as a Ghanaian company. Instead, you create a complex corporate structure. Your parent company is registered in the Netherlands or Luxembourg countries with favorable tax treaties. Your financing subsidiary is in Ireland. Your intellectual property holding company is in Bermuda or the Cayman Islands. And your actual mining operation in Ghana is just one small piece of a global corporate puzzle. Now, here's where it gets clever. The Ghanaian subsidiary Tawan actually extracting the gold doesn't sell the gold directly to customers. Instead, it sells the gold to another subsidiary you own. This one based in Switzerland or Singapore. But here's the key. You sell the gold to your own subsidiary at an artificially low price. Let's say the gold is worth $100 million on the global market. Your Ghanaian operation sells it to your Swiss subsidiary for $20 million. On paper, your Ghanaian operation just made a very small profit, maybe even a loss once you account for operational costs. And in Ghana, where corporate tax rates might be 35%, you barely owe anything because you barely made any profit. Meanwhile, your Swiss subsidiary, which did nothing except exist on paper, turns around and sells that same gold to actual customers for the full market price of $100 million. It just made an $80 million profit. But Switzerland has much lower corporate tax rates. And you've structured things so that even those taxes can be minimized through other schemes. This is called transfer pricing, and it's the single biggest mechanism through which corporations drain wealth from Africa. But we're just getting started. Remember that intellectual property company you set up in Bermuda? Well, your Ghanaian operation doesn't just extract gold, it also uses proprietary mining technology, brand names, and corporate expertise, all of which are conveniently owned by your Bermuda subsidiary. So your Ghanaian operation has to pay licensing fees and royalties to your Bermuda company for the right to use this intellectual property. These fees are tax deductible in Ghana, meaning they reduce your taxable income even further. But Bermuda has zero corporate income tax. So the money flowing into your Bermuda subsidiary sits there untaxed, accumulating. Now let's add another layer. Your mining operation needs financing to build infrastructure, buy equipment, and cover operational costs. Where does that money come from? Not from the parent company directly, that would be too simple. Instead, your Irish financing subsidiary lends money to your Ghanaian operation at high interest rates. Your Ghanaian company now pays massive interest payments to your Irish subsidiary. These interest payments are tax deductible in Ghana, further reducing your tax burden there. Meanwhile, Ireland has special tax arrangements for corporate financing operations. So the interest income is taxed at minimal rates or routed through additional structures to avoid tax entirely. Let's recap what just happened. Your Ghanaian operation sold gold to your own company at below market prices, paid licensing fees to your Bermuda subsidiary, paid interest to your Irish financing subsidiary, deducted all of these costs from its taxable income. On paper, your Ghanaian operation barely made any profit. You might have even reported a loss. Ghana gets almost nothing in tax revenue from billions of dollars worth of gold extracted from its soil. Meanwhile, the actual profits are sitting in Switzerland, Bermuda, Ireland, and the Netherlands jurisdictions carefully chosen for their low tax rates and secrecy protections. This isn't a hypothetical scenario. This is standard operating procedure for multinationals operating in Africa. Mining companies, oil corporations, tech giants, pharmaceutical manufacturers, they all use variations of this structure. And here's the thing that should make you angry. It's all legal. These corporations aren't breaking laws. They're using low tax codes, treaties, loopholes that were deliberately designed to allow this kind of profit shifting. Wealthy countries created this system. Their law firms, accounting firms, and banks maintain it. Politicians who receive corporate donations protect it. The Tax Justice Network, a research organization that tracks global financial flows, estimates that African countries lose $89 billion annually to corporate tax avoidance alone. When you add individual tax evasion, illicit financial flows from corruption, and trade misinvoicing, the total reaches $200 billion or more. That's not money from the distant past. That's not colonialism as a historical artifact. That's this year, and next year, and every year, as long as the system remains unchanged. So who exactly is doing this? And where is the money going? Let's start with the tax havens themselves, the jurisdictions that make this entire system possible. When you think of tax havens, you might picture tropical islands with palm trees and offshore bank accounts. And yes, places like the Cayman Islands, Bermuda, and the British Virgin Islands play a major role. But some of the world's biggest tax havens are in Europe and fully integrated into the global financial system. The Netherlands, Ireland, Luxembourg, and Switzerland are among the most significant enablers of corporate tax avoidance in Africa. These aren't rogue states or isolated islands. These are wealthy European democracies that have deliberately structured their tax systems to attract multinational profits at the expense of developing countries. The Dutch tax treaty shopping system is particularly egregious. The Netherlands has tax treaties with many African countries that were designed, in theory, to prevent double taxation and encourage investment. In practice, these treaties have become vehicles for profit shifting. A mining company operating in Zambia can route its profits through a Dutch subsidiary paying minimal tax in Zambia and minimal tax in the Netherlands before moving the money to an even lower tax jurisdiction. The Netherlands takes a small cut as a transaction fee, and Zambia loses billions. Ireland has become the European headquarters for American tech giants like Google, Facebook, and Apple specifically because of its favorable tax arrangements. These companies provide services to African users, generate revenue from African advertisers, extract data from African consumers, but pay virtually no taxes in African countries because the profits are booked in Ireland, or more accurately routed through Ireland to even more tax-advantaged locations. The double Irish with a Dutch sandwich was a famous scheme where profits would flow from an African or European operation to an Irish subsidiary, then to a Dutch subsidiary, then to another Irish subsidiary that was tax resident in Bermuda. Ireland eventually closed this specific loophole under international pressure, but new variations have emerged to replace it. Now let's talk about specific companies and sectors. The extractive industries, mining, oil, and gas are the biggest culprits. Companies like Glencore, one of the world's largest mining and commodity trading corporations, have been repeatedly accused of using tax havens to minimize payments in countries like Zambia and the Democratic Republic of Congo. A 2011 investigation found that Glencore's copper mining operations in Zambia were selling copper to Glencore's own Swiss trading subsidiary at prices significantly below market rates. The Zambian operations reported minimal profits and paid minimal taxes, while the Swiss operations made billions. Zambia, one of the world's largest copper producers, was losing hundreds of millions of dollars annually to this practice. Oil companies use similar tactics. In Nigeria, Africa's largest oil producer, international oil corporations have complex joint ventures with the Nigerian National Petroleum Corporation through transfer pricing, inflated costs, and offshore subsidiaries. These companies minimize their tax obligations while extracting billions of barrels of oil from the Niger Delta. A report by the Natural Resource Governance Institute found that Nigeria loses an estimated $15 billion annually to tax avoidance by oil companies alone. To put that in context, Nigeria's entire annual health budget is about $4 billion. The money being stolen through tax schemes every year could quadruple Nigeria's healthcare spending. Telecommunications companies are also major players. Mobile phone providers operating across Africa often have parent companies in tax havens. The license fees, technology payments, and management fees they charge their African subsidiaries are structured to minimize taxable profits in Africa while accumulating earnings in low-tax jurisdictions. Even companies you might not immediately think of participate in this system. Major accounting firms, the so-called Big Four of Deloitte, PwC, Ernst & Young, and KPMG don't just audit corporate books. They actively designed these tax avoidance schemes, selling sophisticated structures to multinational clients while simultaneously advising African governments on tax policy. The conflict of interest is staggering. Law firms in London, New York, and other financial centers specialize in creating shell companies, trusts, and complex corporate structures specifically designed to hide wealth and avoid taxes. When African governments try to crack down, these firms find new loopholes or lobby for favorable treaties. Banks are the infrastructure. HSBC, Standard Chartered, Barclays, and others provide the accounts, facilitate the transfers, and often fail to conduct adequate due diligence on the source of funds flowing through their systems. Leaked documents like the Panama Papers and Paradise Papers have revealed the extent to which major banks knowingly facilitate money laundering and tax evasion. And then there are the individuals, African elites, corrupt officials, and oligarchs who use the same tax haven infrastructure to hide stolen wealth. Former Nigerian dictator Sani Abacha stole an estimated $5 billion and hid it in Swiss and British banks. Angola's former president, José Eduardo dos Santos, and his family accumulated billions, while the country remained impoverished, using shell companies in tax havens to hide their wealth. The system doesn't discriminate. It serves multinational corporations and corrupt individuals equally well, as long as they have enough money to make it worthwhile for the lawyers, accountants, and bankers who make the system work. So what does $200 billion actually mean for Africa? It means schools that don't get built. It means hospitals without equipment. It means roads that remain unpaved, water systems that don't reach villages, electrical grids that don't expand. Let's make this concrete. The annual tax revenue lost to corporate tax avoidance, although $99 billion is more than enough to fund the entire education budget for every country in Africa combined. It's enough to provide universal primary health care across the continent. It is enough to build the infrastructure that African countries desperately need, but are told they can't afford. When Western governments and international financial institutions talk about Africa's development challenges, they rarely mention that Africa is a net creditor to the rest of the world. More money flows out of Africa through tax avoidance, debt service, and repatriated profits than flows in through aid and investment. A 2017 report found that for every dollar Africa receives in aid, it loses $14 to tax havens, debt payments, and capital flight. Africa isn't poor because it lacks resources. Africa is poor because its resources are being systematically extracted and its tax base is being systematically eroded. The human cost is measured in lives. The World Health Organization estimates that African countries need to spend at least $86 per person annually to provide basic health care. Many African countries spend less than $20 per capita because they lack the tax revenue. The money that could fund those healthcare systems is sitting in Swiss bank accounts and Irish subsidiaries. Every year, hundreds of thousands of children die from preventable disease, diarrhea, pneumonia, because healthcare systems lack funding. Every year, millions of children don't attend school because there aren't enough teachers, classrooms, or materials. Every year, economic opportunities are lost because infrastructure doesn't exist. This isn't nature or fate or cultural deficiency. This is policy. This is a system designed to extract wealth and call it free trade. So what can be done? First, transparency. The global financial system operates on secrecy. Shell companies hide true ownership. Tax havens refuse to share information. Banks process transactions without asking questions. Mandatory public country-by-country reporting would require multinational corporations to disclose exactly where they operate, how much revenue they generate in each country, how many employees they have, and what profits they report. This would make transfer pricing manipulation immediately visible. Beneficial ownership registries would require that the true owners of every company and trust be publicly disclosed. No more anonymous shell companies. No more hiding behind layers of subsidiaries. Second, international cooperation. Tax avoidance works because money can flow freely across borders while tax authorities cannot easily follow it. African countries need access to the same financial information that wealthy countries share among themselves. The OECD's Common Reporting Standard requires automatic exchange of financial accounts information between participating countries, but many tax havens have not fully implemented it, and enforcement is weak. Stronger international pressure and sanctions against non-compliant jurisdictions would help. Third, renegotiate tax treaties. Many of the tax treaties between African countries and wealthy nations were negotiated decades ago, often during the colonial or immediate post-colonial period. These treaties are systematically biased in favor of capital exporting countries and should be renegotiated or terminated. Fourth, unitary taxation. Instead of allowing corporations to shift profits between jurisdictions, tax them based on where they actually conduct business, where their employees are, where their customers are, where their assets are. Several proposals for global minimum corporate tax rates and formulary would make profit shifting much harder. Fifth, enforcement. African tax authorities need more resources, better training, and stronger legal authority to investigate and prosecute tax evasion. International support should focus on building institutional capacity rather than just providing aid. Sixth, sanctions and consequences. Countries and corporations that facilitate tax avoidance should face real penalties. Tax havens should be excluded from international financial systems. Banks that process illicit funds should lose their licenses. Accounting firms that design abusive schemes should be prosecuted. The global minimum corporate tax rate of 15%, agreed to by more than 130 countries in 2021, is a small step in the right direction, but it's too low, has too many exceptions, and lacks strong enforcement mechanisms. What's really needed is a fundamental shift in how we think about taxation and sovereignty. The current system treats corporate profits as mobile and footloose, able to be assigned to whatever jurisdiction offers the lowest tax rate. But profits don't exist in the abstract. They're generated by workers, customers, infrastructure, and natural resources, all of which exist in specific places. A just tax system would recognize that when a company extracts copper from Zambia, the value of that copper belongs first and foremost to Zambia. When a company provides telecommunications services to Nigerian customers, the profits from those services should be taxed in Nigeria. When a company uses Ghanaian labor to produce goods, Ghana has the first claim to tax those profits. This isn't a radical idea. It's basic fairness, but it would require dismantling a system that powerful interests have spent decades building and defending. The $200 billion flowing out of Africa every year is an accident or an unfortunate side effect of globalization. It is the intended result of policies created by wealthy countries and their corporations to ensure that capital can move freely while the costs are borne by the poorest people on earth. When you hear that Africa needs aid, remember that Africa is giving far more than it receives. When you hear that African governments are corrupt and mismanaged, remember that the global financial system is designed to help those governments, elites, hide stolen wealth. When you hear that African countries need to attract foreign investment, remember that the investment already there is extracting far more than it contributes. This is neo-colonialism in its purest form, not soldiers and flags, but spreadsheets and subsidiaries. Not direct political control, but financial architecture that achieves the same result: wealth flowing from the global south to the global north, from the poor to the rich, from those who create value to those who control the systems that capture it. $200 billion every year, stolen in plain sight. The question isn't whether this is happening. The evidence is overwhelming and documented. The question is, what are we going to do about it? Because until we dismantle the tax haven system, until we demand transparency and accountability from multinational corporations, until we restructure the global financial architecture to serve human needs rather than corporate profits, this theft will continue, and every year it continues. Hundreds of thousands of people will die preventable deaths. Millions of children will be denied education, and entire countries will be trapped in poverty, not because of scarcity, but because of a system designed to extract their wealth and call it progress. That's the truth about tax havens. That's the truth about how $200 billion disappears from Africa every single year. Now, the question is, what will you do with that knowledge?